This is the Rocket City Retirement Show with Cris Wallace. Cris loves educating people in person and over the airwaves. Whether it's retirement planning, investing, tax, or legacy, Cris prides himself in helping protect what matters to you. This is the Rocket City Retirement Show.
Hey there, welcome to the Rocket City Retirement Show. And as you've noticed, this is not Luann's voice opening the show this week. So it's going to be just myself and Richard. Graham is actually out of town this week. So we're going to basically have two nerds on the radio trying to talk some financial sense into the Huntsville area. And just before we opened the show, I was telling Richard I almost opened with my old show name. So that was kind of funny. So again, we just want to welcome you to the show. And, because Graham is not here today, I'm not going to try to do what he does with WG Positivity. Graham does a phenomenal job with that. And I feel like if I tried to do that, I would be out of my lane. So what I want to do today is I want to stay in my lane, and really just talk financial stuff. And Richard and I are going to go back and forth. As you guys know, Richard's a very data-driven individual, such as myself. So we'll kind of get started. So I do want to start with a little bit of a market update. I think it's always important just to kind of bring that to the forefront so that we can talk about, where is the market today? And just looking at the S&P in general, the S&P is up nearly 8% on the year. So I think that's a great start to the year. I mean, I think over the past 2 years, I think if we were to look back at what we as investors may have expected, it probably wasn't what we had last year, and probably not an 8% start to the year this year. So the S&P is up 8%. Mid caps are up about 5.8%. And small caps are running just slightly negative. So here again, we have the S&P kind of leading the charge. And I do want to note the aggregate bond index. I think it's important to always talk about that, because when you're looking at the bond index, I think that is really the index that's in a lot of 401ks. So again, if you're a federal employee out there today, that would be the F fund in your TSP. So if you're looking at the aggregate bond index year to date, it's actually negative. And then I'll mention one other area that I know a lot of people like to look at, and that's gold. And gold is positive this year as well. Gold's actually been on quite a run as of late. So that's kind of the state of, let's say, the indexes, and just the overall state of the market. We still feel like the market is in a pretty good place. When you look at the economy in general, you can look at just the consumer spending, and it's still incredibly elevated at this point. And I think it will continue to be elevated for quite a while. And as long as we, the consumer, are out there spending, and as we head into summer, which is, a time when we tend to spend more money, I think the economy will tend to stay stronger at this point. The one thing that I do think is worth noting is last week, unemployment numbers came out. And unemployment actually crept up to 3.9%. I believe it was 3.8% the month before. And that's the highest level since 2022. Now, the number itself doesn't seem too frightening when you think about 3.9. It's still really low, almost historically low. And I would totally agree with that. But if you just look at the numbers over the past 1 year, there's a slight upward trend that I think is worth noting, and then also worth following to kind of see where that goes. Because if you think about the feds and are they going to reduce rates, and one of the areas that they look at is that unemployment number. Remember, they have two main mandates, and that is to maintain price stability and then also maximum employment. So if we see unemployment kind of trickling up and we still have, let's say, higher inflation, what do the feds do at that point? So I definitely think that's an area worth watching. And then the other thing that came out last week is the feds, from their meeting, noted that they were going to start to slow the balance sheet reduction from $95 billion a month to $60 billion. And so this is a move to really reduce quantitative tightening. So I found that a little bit strange, because I still think they need to continue that, but they didn't lower interest rates, but they did reduce the balance sheet reduction from $95 billion to $60 billion. So I thought that was kind kind of interesting, I guess, to say the least. So we're going to do something we don't normally talk about on the show. We're going to talk about it this week, and I'm going to hand it over to Richard here, and we're going to talk about earnings releases. So companies, throughout the year have, what they call earnings releases, and it basically is a measure of how well the companies are performing. So I kind of want to hand this over to Richard, and we're going to talk a little bit about, the S&P and the Dow, and then some different companies as well. So Richard, I'll hand it over to you at this point. So let's talk about earnings releases.
All right. Thanks, Chris. So Q1 tends to be a very important time of the year for companies. One, they're getting started for their new year. They're seeing different trends in products. They're also recovering from everything that happened during the Christmas time and other holidays. And so, for companies like, Exxon, right? Like gas companies, people are traveling more, so that's beneficial. It's also important for other tech companies like Apple, for example, how many iPhones were actually sold during the Christmas time. And so Q1 is an important time for earnings. So far, as of this recording, 80% of S&P 500 companies have reported earnings so far this quarter. So far, 77% of the companies who have reported have beat expectations. That is above the historic average of 74% of companies that beat earnings. And the 74% is the 10-year average. And, why this is important, especially at this year in particular, is, we've now had higher interest rates for, over a year and a half now, almost 2 years now. And companies are still being able to generate profits on their business activities. And so, without profits, then, there's no company, right? And so it's very reassuring that even in our current interest rate environment, companies are still doing well overall.
I want to ask a quick question real quick, not to mess your flow up here, but when you mentioned first quarter is important, we're actually, obviously in second quarter here. Are you talking about year to date when you say that, would you say 77% have beat their earnings expectations, which is above average? Are you talking year to date, or are you talking just second quarter? Because
that was their Q1 earnings report. Gotcha. Each company has a slightly different quarter system. Mm-hmm. For example, Apple's quarter is actually December, January, February, where some companies run off of a quarter being January, February, March. Okay, and gotcha. So each company is a little bit different, but regardless, it all encompasses their first earnings report of 2024.
Mm-hmm. Got it. Okay, good stuff.
Yeah, absolutely. And so, what we've been watching really closely is how the big players are going to report their earnings. So for listeners out there that do not know, the S&P 500 is composed of 500 companies, but it's not like each company has the same weighting in that indice. So the indice is based off of how large that company is as a whole. So just to make math easy, let's say a company is worth $1 billion. And company 2 is worth $500 million. Since company 1 is double the size of company 2, company 1 is going to have double the impact on the S&P 500. So currently, the 7 biggest companies in the S&P 500 are Apple, Microsoft, Google, Amazon, NVIDIA, Facebook, and Tesla. So far, 6 of those companies have reported earnings. 5 of the 6 companies have reported better than expected earnings. And so why this is important is that, the leaders of the S&P 500 are still providing, they're still growing, and they're still, earning income for their shareholders, and thus boosting the entire market as a whole.
Mm-hmm. So Richard, one of the things I know that I've heard a lot, I'm sure that you hear it as well, and I'm sure that people listening to the show right now, one of the common themes is, well, it's only a handful of companies leading the S&P. Everybody else is doing terrible, and it's only like the Magnificent 7 or 8 or whatever that's doing well. And so before the show, we know there's a lot of people thinking that out there. So I thought it was helpful that actually we wanted to provide some kind of insight that this is kind of normal. There's always in, a given year, there's always going to be a select few companies that really, pull the other companies, through the market, so to speak. So like if you look at 2015.
Well, and Chris, also on that, it's beneficial for investors that the S&P 500, the companies who are leading the charge, that they change, right? Because, we don't want an old dinosaur still being the number one company in the S&P 500 in 1995. We don't want that company to still have the most weight on our investments as of 2024, right? So we want the people who are the companies who are actually changing the world to be leading the charge.
Yeah, good point. Excellent point here. So let's just dip back to 2015 and the top 7, and I'll start from 7 to number 1. 7 was Wells Fargo, then Johnson & Johnson, Alphabet, Berkshire Hathaway, Microsoft, ExxonMobil, and then Apple. If we scoot back to 2005, it ends up being, let's see here, 1, 2, 3, 4, 5, 6, 7. So it was Pfizer, starting again from 7, Pfizer, Bank of America, Walmart, Citigroup, Microsoft, General Electric, and then ExxonMobil. And if we go all the way back to 1995, we have, get this one, local company here, Raytheon, IBM, Procter & Gamble, Merck, Walmart, Coca-Cola, ExxonMobil were your top ones then. So to your point, Richard, I think it is good, like you just mentioned, to have companies that are, essentially changing the world with their product release, kind of leading the charge there. I think it also bodes well for, the reality that everybody should be diversified, because it's always very difficult to pick, the individual winners each year.
Oh, yeah. I mean, if we looked back at 1995, right, when Coca-Cola was the number 2 size company in the S&P 500, it's easy to say, I drink Coke every day. Let's put all our money in it, right? But if you weren't diversified, you wouldn't have seen any of the growth in the S&P 500 that is replacing Coke's top spot in it back in 1995.
Correct. Yeah, absolutely. You were just talking about Coke. I thought it was kind of interesting. Coca-Cola, the drink there. Make sure that's clear on the radio. One of the things back in 1995, I just wonder if there's any correlation to this, but do you know who one of the major sponsors, Coke was a major sponsor to a specific athlete back in 1995. I'll give you a couple guesses here. You probably know it.
I mean, the first guess is MJ.
That's right, is Michael Jordan.
Okay.
Yes, so I just happened to think about that as we're kind of rolling through these companies here, and who are leading the pack back in 1995. So good stuff here, good show opening, a little bit different, probably a little bit different vibe here. But all in all, this show will be a lot more data driven than what we do before, which will appeal to some different people and whatnot. And some people are like, "Oh, this is kind of boring. I miss Luann," and I do too. And I'll tell you what happened. I was actually flying out to do my TV recording with Luann, and I had just boarded the plane. I'd been on the plane literally 8 minutes, and I get a text from her letting me know she had a fever. So I flew all the way out, got off the plane, went and grabbed lunch, and caught a plane right back here. So Luann is still out sick. And like I said, Graham just graduated college. So if you want to go to our Facebook page and congratulate him, I'm sure he'll be glad to see that. He's actually out of town as well. So it's just Richard and I, as I said. So if you'd like to give us a call and set up a discovery session, you can do that by calling 256-937-2010. Again, the number's 256-937-2010. This is the Rocket City Retirement Show, and we'll be right back.
Want to feel confident in your financial future? Let Cris Wallace from WG Financial be your guide. Take the first step today by visiting WGFinancialGroup.com.
Wait. Now, wait a little longer. Great. You may have just increased your lifetime income by tens of thousands of dollars. That's how Social Security can work for you. The longer you wait, the more money you may get. Deciding when to start taking your Social Security benefits is one of the most important retirement decisions you'll make. Cris Wallace and the team at WG Financial Group can show you the options and help make the right decision for you and your situation. Call them today, 256-937-2010. You spent decades paying in. Optimize what comes out. Cris Wallace and the WG Financial Group team can help you squeeze every penny out of your Social Security benefits. Don't wait any longer. Call now, 256-937-2010. That's 256-937-2010. Investment advisory services made available through AE Wealth Management, LLC, a registered investment advisor. Firm is not affiliated with the U.S. government.
Get the most out of your retirement with WG Financial Group's comprehensive investment and wealth management services. While we don't fully endorse active investment management, we believe in regular portfolio adjustments to potentially achieve better returns for our clients. Schedule a meeting today by calling 256-937-2010. That's 256-937-2010.
Welcome back to the Rocket City Retirement Show. This is Cris Wallace and Richard Constantine, two certified financial planners that work at WG Financial Group. So we want to get back into segment 2 of the show today. Richard, when we closed out the last segment, we were talking about, different companies leading the S&P. A lot of the information that's out there today, talks about the Magnificent Seven or the Magnificent Eight leading the market, and it's them pulling the whole market. And one of the things we kind of wanted to bring to light that's kind of normal. It's like that. It has been throughout history. So we talked a little bit about that. But during the break, you actually pointed out something to me, and I'll actually post this link on our website, our company Facebook page, rather, so that if you're interested in seeing this, I actually found it incredibly interesting. I'd like for you to talk about what you mentioned during the break in terms of the company colors related to the industry that they're in.
Yeah. So if you go to the link, what it's going to show is it's going to be a bar graph and bar chart, and each color of the bar that is associated with a company is going to be a different color. And the color that is represented is the industry that they're in. And so the S&P 500 is broken down into 11 different industries, like Apple and Microsoft and NVIDIA, they are strictly tech companies, whereas like Alphabet and Facebook-Meta, however you want to call them, right? They're technically advertising businesses.
It's sort of like Twitter and X, right? I can't call Twitter X, and I
exactly.
can't call Facebook Meta. It's just hard.
Exactly. And so, I find it very interesting to just look at different data sets, right? And, you can clearly see that different industries inside of that S&P 500 are actually what is leading the charge. If we go back to 1990, we had 4 different healthcare companies leading it and 5 different consumables, essentially. So like Coke, the consumer drinks it, it's consumed, it's gone. Pepsi, consumer drinks it, it's gone. Whereas in 2024, we have 2 consumers, spendables, and 3 healthcare groups. And so, times change, and, fortunately, the S&P 500 adjusts with it.
Yeah, I guess good point there. Good point. This is this is really interesting. I literally, as Richard was sitting there talking, I just went out and posted that link on the Facebook page so you can go check it out. I found it incredibly interesting. I'm sure that you will too. It'll also probably be a little bit nostalgic for some people because it kind of took me back to, like I mentioned Michael Jordan and Coke being a sponsor of Michael Jordan back in the day. And, I remember that pretty vividly. So let's move into an article that, you sent me this week. And as we were trying to determine whether or not we were going to do this radio thing without Luann and without Graham here, and we decided, hey, let's nerd out a little bit. Let's take it a little granular for some of our listeners, and then let's kind of zoom back out for some of the listeners that prefer more top level stuff. So there was an article, or really it was more of a study, and then an article was published because of it, and it was done by Vanguard, and the article is basically about the alpha that the potential alpha, I should say, that an advisor could add just by engaging with them. And I think to kind of step into this, one of the questions that I've been asked probably the most of any question ever, Richard, I'm sure it's the same for you as well, is, what do you charge? I think the consumer out there, the investor that's looking to engage with a certified financial planner, is obviously wanting to know what that person charges. And I've seen situations and been a part of them here recently, conversations, meetings, where I could tell the individual, the family who was looking, at us as for a potential solution for their retirement, they are very inquisitive about the fee, but then I can tell by the languaging, the body language, the behavior, that is where the emphasis of their, I guess, interest lies. It lies within how much do you charge. And I think sometimes you can focus so much on the fee that you miss some other forms of value. And I think this article does a really good job of actually like highlighting some of that. So Richard, with that, I'll kind of let you kind of start us off in this article. Again, I'll post this out there as well on our Facebook page as well. So Richard, if you just want to take it away, I'd like to kind of walk through this. You and I were talking offline yesterday.
It's so, Chris, I mean, to lead off, I mean, when you and I think of Vanguard, personally, I think of a low cost ETF, right? Or is that kind of your mindset too?
Oh, 100%. 100%. A lot of people, and to be honest with you, like Vanguard's not always the lowest, but in people's mind, that's what they think. That's what I think right off the bat is Vanguard, low cost.
Exactly. Well, and so the funny thing about this study, it was done when Vanguard was launching their robo-advisor program. And they were trying to quantify that working with a human advisor is not beneficial. And in fact, that actually in their study, they realized that it is very beneficial to be working with a person. Their thought was that they set out to prove that an individual can and should do it on their own, but their study showed that that's not, in fact, the case.
Yeah, that's really interesting. When we talk about robo advisors in general, I think a lot of people would still prefer, even though we're kind of tech heavy in the world today, and we're going to get more and more tech heavy. There's a lot of people that would really still prefer to sit down with a human. And it was interesting that this article was really, you could say it was targeted, or this paper was actually targeted to kind of boost, their robo system. And then they later found out that maybe not so much.
Oh, it is. Yeah. It completely disproved the fact that they were trying to prove. And yet, kudos to Vanguard that they still released the article.
Yeah, because it could have been detrimental in a sense to them.
But yes, so Vanguard, this Vanguard study that we're referencing, it came out in 2022. They essentially graded what an advisor can add to a client through 7 different areas. The areas were asset allocation, cost-effective implementations, and what that really means is the expense ratio charged by the underlying funds, the value of consistent rebalancing, the value of behavioral coaching, the value of asset location, the value of spending strategies, which is really where to take funds from during your retirement years. And the last section was the total return versus investing on your own. So all of those combined, Chris, what do you think is kind of the most widely, or what they think is adds the most benefit?
I have the article in front of me, so I've done some, reading on this. It's not what I would have thought. Okay. Mm-hmm. So I can tell you it's not what I would have thought. So had you asked me this without showing me the article, I'm probably going to say expense ratios inside of funds, because I see that a lot. And that's an area of focus for us when somebody comes in. But yeah, that's what I would have said. So out of all of these areas, what adds the most, I would say it would be that expense ratios would have been my answer. Yeah.
And that seems very true, right? Because, most of the clients that we see, they're in still high cost mutual funds. Whereas if we work with them, I mean, we're immediately able to lower their expense ratio. Vanguard quantified that value at roughly 0.3% in value that an advisor can add in 1 year.
Mm-hmm. Real quick on that expense ratio, I kind of want to mention this, Richard, and you may have something to add here as well. But when we're talking about fund expenses, so let's say you have a mutual fund that you purchase. That fund itself has an expense ratio. So the mutual fund manager and the team that's running that particular fund, they charge a fee for that. And so those funds have a fee associated with it. A lot of individual investors out there, it's becoming less common than it used to be. But I would say 10 years ago, people didn't know that they were actually paying additional fees inside of those funds. They basically thought they were buying the fund and it was for free.
Yeah.
And,
I think they're comfortable with me saying this, but one of the clients I'm working with right now, they inherited this mutual fund 15 years ago, and it's a little over $200,000, right? And so the fees that they're paying inside that mutual fund, the expense ratio was 0.88%.
mm-hmm.
And so each year they're paying $1,760 in fees that they didn't even know they were paying. Inside that mutual fund. And if we actually look at the charts, that they have lost money in the past 3 years, where the S&P 500 is now reaching new highs. But all of the dollars that they have lost, you could just quantify it as that's coming from the expense ratio cost.
Yeah, I mean, you're at that point. The other thing I would kind of add to that is, well, number one, that's exactly right what you just said. Number two, I think you have to ask yourself, if I'm paying, let's just call it nearly 1% in a mutual fund fee, you have to ask yourself, okay, do I know these people, right? I mean, am I having conversation with the mutual fund folks, right? You don't know them people.
I think that answer is no, 100%.
The answer is no, right? The other answers that will be no is, are you getting, distribution advice? Are you getting Social Security planning advice for your retirement? Are you getting Medicare planning advice? Are you getting long-term care? The answer is no to all of that. And so when these funds are sold to you in this case, Richard, was this a front or back end loaded fund? I didn't ask, or you didn't state.
It was a Class C share, so it was an ongoing.
Okay. So we've got basically a back end loaded fund with C shares there. And so a lot of times when these mutual funds are sold to you, they're commission based funds. So it literally costs you to get into the fund depending on what the loads are. So it basically it's a loaded fund. Right off the bat, we're of the mindset that there are just so many funds available today that we don't feel somebody should have to pay to get into a fund. It's ridiculous to pay to get into a fund. The second way that it's kind of sold to you is, hey, it's going to cost you to get in. So I'll kind of go into character here, if you will. So I'm selling a loaded mutual fund. We don't do that, but if it was if you were approached by someone who's doing that, it probably went something like, hey, this fund cost a 5.25 load to get in. It's going to cost you money to get in, but hey, we know these people. They do a really good job at managing this fund, and you'll make that money up in no time. And that's typically how they are presented to you. The other thought process that I have heard since my time in the industry in 20 plus years is, well, when you buy this front loaded mutual fund, the fees are lower. But that's not at all what we see when we're doing an analysis on these mutual funds that people walk into the office with. A lot of times they're front or back end loaded, and they still carry a 0.6, 0.7% expense ratio. So it's incredibly high, and you paid a load to get in. The other thing I'll say as we wrap up here and head to a break is, if you are in a basket of purchased mutual funds, how much incentive does the advisor have to review that portfolio when he or she has already been paid on it? I'll let you answer that. And if you want to come into the office and talk about that, you can give us a call at 256-937-2010. Again, our number is 256-937-2010. This is the Rocket City Retirement Show, and we'll be right back.
Don't panic in uncertain market times. Let Cris Wallace be your trusted guide. Call Cris Wallace today at 256-937-2010 for expert advice and support. That's 256-937-2010.
Quarters, just 25 cents. That's hardly anything, right? But Cris Wallace and his team at WG Financial see quarters a little differently. A quarter is a lot when it's a quarter of your retirement savings. Now, do you want to pay 25% or more in taxes during your retirement? Well, Cris can create a plan to help address that. Now, if the only time you think about taxes is when you file them, you don't have a tax strategy. But it's not too late to get one with the help from Cris Wallace. So act now to make sure you're not paying a quarter, dime, or even a penny more than you should. Call Cris Wallace and his team at WG Financial at 256-937-2010 to schedule your personalized tax strategy session. A quarter saved is a quarter earned. Call 256-937-2010 now. That's 256-937-2010. Investment advisory services made available through AE Wealth Management, LLC, a registered investment advisor. Firm may not give tax advice.
Want to feel confident in your financial future? Let Cris Wallace from WG Financial be your guide. Take the first step today by visiting WGFinancialGroup.com.
Welcome back to the Rocket City Retirement Show. I'm Cris Wallace, your host today. Richard Constantine is here with me. We are absent Luann and Graham today, so it's just two data nerds talking finance on the radio today. So, Richard, we are in the middle of talking about a Vanguard study from 2022 where it's basically they did some research when they launched their robo platform, and then they found out that, through that study, which kind of went against their launching of the robo platform in a sense. But basically the alpha that a advisor can potentially, add. And we were talking before this segment and the last segment, one of the ways that we can add alpha. What are some of the other ways that this study actually showed?
Yeah. So another way is the value of rebalancing a client's portfolio. Vanguard quantified that a little bit lower at 0.14% in value per year. What rebalancing means is that, if you bought two funds, the S&P 500 at 60% and a bond fund at 40%, well, the S&P 500 grows to 65% of your portfolio and the bonds are now at 35%. Well, the value of rebalancing is to actually get it back to that 60-40 model. And so that's one way that over a long period of time, Vanguard sees advisors helping with that.
Can I add something to that?
Yeah.
Why that's a problem?
Absolutely.
The lack of rebalancing. This is
right.
something.
Well, most people never rebalance.
No, exactly. This is my point. Exactly. So you're right. People come into the office and we'll usually just in the first meeting, you can't determine whether or not somebody's conservative. I mean, you can, or aggressive. I mean, you can, but there's more things that need to be asked. And we don't dive completely into that in the very first meeting. So like in a first meeting, I may ask a family, they're getting ready to retire. Maybe they're like 63 years old. Do you see yourself as more of a conservative investor? So that's kind of how we start the conversation on risk, just in the first meeting. And they might say, oh, yeah, I'm really, really conservative. And then we start looking through their statements. And then, through between the first and second meeting, we're doing our analysis work on it. And then we find out they're very aggressive. And a lot of the reasoning behind that is they are in that loaded mutual fund portfolio that we talked about. And it's really never been rebalanced. And to your point, Richard, if they were 60-40 and we just look at the last 15 years of growth in the S&P, maybe the equity side, not maybe, in the last 15 years, equities just crushed bonds. So maybe that 60-40 might have went to an 80-20. And that person getting ready to retire is sitting there very exposed to risk because they're remembering the conversation from 10, 12, 15 years ago. It's like, hey, I'm conservative, so my person has to be conservative.
Well, and Chris, like to your point, I mean, like the S&P has grown significantly, and that's been great for clients that have not been rebalancing, even though they, should have. But going forward, if something happened where the equities fall, 30% and bonds rise 10%, right? Well, if they're at a 60-40 like they should be, that's not going to have as nearly as drastic of a negative impact on it.
Correct.
If they haven't rebalanced and are at 80-20. And so it's a huge, red flag in some of our clients' portfolios that have not been onboarded yet.
Yeah, no, that we see that. That's very, there's listeners out there today listening to the show that are sitting in that position and they don't know it because there's that old saying, I don't know if it's an old saying or a new saying, or it's just the saying that you don't know what you don't know. And right. That's the case. There are people out there, there are families out there today who are sitting there in an unbalanced or not rebalanced portfolio, hasn't been rebalanced in 10 or 15 years, and they're overexposed and don't even realize it. Now, it could have been to their benefit, like you just said. It could, over the last 10 or 15 years since they didn't rebalance, it probably benefited them. But at the same time, it can also hurt them. The other area that I think the not rebalance, and this is probably why Vanguard, added the 0.14, 14 basis points, value add there of rebalancing is, let's just say that, maybe they started in value funds, versus growth. And if they were in value funds in the last 10 years, they got hammered, meaning they didn't make near the growth of the S&P, because the value side of the S&P hasn't done well. If you just look at value stocks in general over the past 10 or 15 years, except for 2022, value stocks did really well. But if you look 10 years pre that, value didn't do anything. It was all growth stocks. So that rebalancing, if they weren't rebalancing, that maybe had hurt them if they were not in the proper sector as well.
Oh yeah, especially like international emerging markets, et cetera. I mean, the list goes on and on. But so another area that Vanguard thinks advisors can add a lot of benefit is on the behavioral coaching side of things.
Woo, behavior. We're going to give somebody a spanking because they got some bad behavior. I mean, it's bad out there.
It's not quite that, Chris, but
yeah, we don't do that in the office, but we see some bad investor behavior for sure.
Yeah. And the main thing of the behavioral coaching is, preventing a client from doing a knee-jerk reaction that's going to limit their long-term plan and really, make really create a situation that is not ideal for a client. Chris, do you have any kind of examples of when you've had to, really help on the behavioral or the counseling side for a client?
So when I had to play mom or dad in the office as an investor, investment advisor. Well, first of all, I do want to say this, and I think you mentioned this yesterday, and I've used this term before. Sometimes that behavioral stuff is protecting them from themselves, right? Because
without a doubt.
Yeah. To your point, the knee-jerk reaction, doing a situation. So yes, I've had the conversation, with individuals, with families who, let's use 2022 as an example. So we obviously know 2022 was a down year in the market, and it was one of these years where it just kept dropping and dropping. And then, on top of that, you had rising inflation. You also had falling bonds. So it was a real,
that summer was painful.
It's incredibly painful, right? The whole year, but especially the summer, because it was like, think of it like when you were, I had it was my dad's cousin. I don't know I'm not good with the whole family tree thing. We just called him Uncle Gary, but he's really my dad's cousin. I don't know. It's the way we did it in Georgia, so no judgment here. But anyway, bottom line is he was always a little rough. So, think of it like if your uncle has your arm behind your back and he continues to just chicken wing you and he's pushing it up and pushing up. And you finally are like, uncle. And that's kind of where people got to in the latter part of summer of 2022. So I had to have many conversations with individuals about, hey, don't jump off the ledge. In other words, don't jump into cash, because if you do that, you don't know when to get back in. And that goes back to what I've said a million times on the show, where you got to be right twice. So at that point, the market's already down considerably. But then what happens is that whole psychological aspect of your thinking and what you believe and the research that you're doing and the website that you're on, and you think the world's coming to an end. And now all of a sudden you're like telling yourself, hey man, we're about to go off the rails. I'm going to go to cash. And then we look at the market performance since October of 2022 through current, the S&P is up 41%. So if you had got out of the market or had gotten out of the market sometime in August, September, early October, you will have missed the market bounce back. And this is why, we typically say to stay in. And to Richard, to your point, yes, I mean, numbers of conversations, just I can't even begin to count on the behavioral, the financial counseling on how you have to look at your money, how you need to stay invested. This is long term. But to be fair, and I had a conversation with somebody this morning who is out of town. He's out of the country traveling. And we were just talking this morning, and he said, Chris, I know you're a lot younger, but man, when you stop working and you turn off your faucet of income and you don't have that income, and you start looking at your savings starting to drop a little bit, and you start thinking about, well, what if I need a roof, or what if I need an HVAC, unit or something like that? He said, it's stressful. Living in retirement can be very stressful, which is, again, why we do the show and why we point back to a financial plan.
Yeah, absolutely. And Chris, one thing that I thought was really interesting about this too is Vanguard highlighted that per year, an advisor adds about 1.2% of value regarding spending strategy for clients. And what that really means is, if you need to spend $100,000, are we pulling all of that from an IRA, non-qualified money, Roth money, or what really proportions we're going with? And, for example, recently we were working with a client who wanted to pay off, their mortgage on their house. And, we were trying to decide which bucket to pull from. And, if they had done it on their own, it most likely would have been a different route than working with someone. And by working with an advisor, they were able to, we were able to help them and get the most cost efficient way to pay down their mortgage.
By using the assets that they had, the different buckets that they had, right?
Exactly.
Because we get it in our heads, I think sometimes, and I'm a man, so I'll say it, sometimes I've got it in my head. I'm gonna do things a certain way. And I can be very hard-headed, and my wife Jennifer will tell you that. Heck, Richard, you may even tell me that too as an employee here at the office. But at the end of the day, I think it's worth being open to different strategies and listening. And I think this is like the engaging of a financial planner where it becomes really important. I think there's a financial advisor. Well, let's say this. I think there's more like your brokers who just kind of do the investments. And then there's more financial planners, which look at the investments. They look at the insurance, essentially,
taxes.
Taxes. I think a financial planner is looking at all elements of financial planning and not just the broker. But I think when you think about the consumer across the table or across your desk, Richard, you may think this as well. I think they're looking at you just to help them with their money. And that's it. That's the feeling that I get a lot.
Yeah, no, I agree. That is what it seems like, in which that's okay in some situations, right? But for the most part, 90% of our clients and people out there, it doesn't really matter your net worth. There are other things that you could be doing better for the whole picture.
Right. It all works together. Don't mistake what we're saying here. The money aspect is really important, but also so is your Social Security claiming strategy. So is your Medicare decisions and what type of, insurance to kind of add with Medicare. The tax picture, huge. The tax picture, I can't even begin to tell you. Matter of fact, I will tell you when we come back from the break, I am actually going to share a story of a high net worth or both high net worth and high income individual that we're working with and what we were able to do there. So taxes is really important, but then you have your estate planning. So think about your estate planning that you work with your estate attorney on your legal documents. We don't do legal documents at the office, but there's other estate items too that need to be addressed. And think of that estate area as kind of like the fence around your entire, financial plan, your whole family. You're locking up everything with a good estate plan. So if you'd like to sit down with us and actually go over all elements of financial planning, you can start that process by giving us a call at 256-937-2010. Again, the number's 256-937-2010.
Want to feel confident in your financial future? Let Cris Wallace from WG Financial be your guide. Take the first step today by visiting WGFinancialGroup.com.
Quarters, just 25 cents. That's hardly anything, right? But Cris Wallace and his team at WG Financial see quarters a little differently. A quarter is a lot when it's a quarter of your retirement savings. Now, do you want to pay 25% or more in taxes during your retirement? Well, Cris can create a plan to help address that. Now, if the only time you think about taxes is when you file them, you don't have a tax strategy. But it's not too late to get one with the help from Cris Wallace. So act now to make sure you're not paying a quarter, dime, or even a penny more than you should. Call Cris Wallace and his team at WG Financial at 256-937-2010 to schedule your personalized tax strategy session. A quarter saved is a quarter earned. Call 256-937-2010 now. That's 256-937-2010. Investment advisory services made available through AE Wealth Management, LLC, a registered investment advisor. Firm may not give tax advice.
Don't panic in uncertain market times. Let Cris Wallace be your trusted guide. Call Cris Wallace today at 256-937-2010 for expert advice and support. That's 256-937-2010.
Hey there, welcome back to the Rocket City Retirement Show. I'm your host, Cris Wallace. I'm here with Richard Constantine. Richard is a certified financial planner who works at the office with me. We are discussing an article actually a study that Vanguard did on how an advisor can actually add alpha or value to a person's or family's financial plan. And so we've gone through this. So if you're catching this show on a Sunday, you're catching the 30-minute version, and to hear the other two segments, you want to go over to Apple Podcast or Spotify and search the Rocket City Retirement Show, and that way you can go back and catch the whole episode. So with that, Richard, I'm going to give it back over to you to talk about the last couple of points here, and then we're going to move into another article.
Yeah, thanks, Chris. And so after adding up all the different segments that Vanguard thinks an advisor can add a benefit to a client's portfolio, it comes out to being 3% or even higher than 3% in some cases for clients. That's 3% each year, right? And that's not just a one-time little kick. I mean, and 3% of $1 million portfolio over 10 years, I mean, that's a significant difference in ending account value. About that too. So there was a study done that showed that over 70% of millionaires work with a financial advisor versus only 37% of non-millionaires working with a financial advisor. And it kind of makes me think about it, right? Obviously, Chris, you and I cannot make someone a millionaire overnight, but correct. Do you think that the way I interpret that study really is that, having a financial advisor, it allows the clients, when they're working, to focus on their work, focus on what they're actually good at and what they're making money at. And then during retirement, it allows them to not have to worry about the money side of things. And that the real benefit of a financial advisor for those people is that it keeps them out of their own way, and it keeps them focused on either making money in their work or enjoying the things that they want to enjoy.
Yeah, I agree. I actually was sitting here thinking about, some of the millionaires that have come in to see us, and they are ones that they didn't touch their investments, number one, and they engaged with somebody that got them investing in the right direction. And, I just do want to say this, there is, I believe, a difference between an advisor who may help you get to retirement, and then there's somebody that's an advisor that helps you get through retirement. Part of our job is a lot of our clients or prospects come to us, they're already wealthy, they're already rich. Part of our job is to keep them rich. And you keep them rich with proper planning. So I think there is value where having that advisor here, and I'm going to talk about a story here that is, has to do with somebody that we're currently working with. So I was actually shocked when this family came into the office. I was actually shocked at their age, and I was shocked at their net worth, and I was shocked at their income. The whole reason they came to see me was because their dad actually listens to the show. He's not a client. He listens to the show, and he said, I think you should go talk to Chris. It's like, okay, cool. So they came in, sat down with me. Like I said, I was kind of blown away. They've done really, really well. They made some really good decisions, but they're at a point where they feel like they're over their head just a little bit. And they are currently working with someone, and I won't say where, obviously, but they work for a banking institution, and they don't feel like they're getting a lot of extra advice when it comes to the whole plan. So one of the things that we have ready for them, because they are going to be coming back in soon, is they own several businesses. So how to structure and pay themselves within those businesses, and also hit the retirement plans that they're supposed to be hitting with the right contributions in effort to lower their taxable obligation. Now, the reason that we're able to kind of structure this is, obviously we have SEC and state, investment regulations and things, but the product availability and the types of account availability that we have, and that we're able to point the individuals, towards, will benefit them greatly in reducing some taxes. It'll also allow them to be able to pay into Social Security a little bit more. It'll also allow them to accumulate more assets for retirement. So this is a younger business owner. And in the words of this person, they say, I'm a one-man show. Okay. All right, cool. That's great. I love it. There's a lot of one-man show business owners out there today listening to the show. They're making a lot of money, and they're probably not doing things as efficiently as they could. I think what I have seen in my experience is that business owners, let's say you own your own business and it's just you, maybe it's you and a spouse. One of the things that I've seen is you try to itemize things away. So you're sitting there trying to come up with all these expenses and itemize yourself away to where your income drops really, really low. And there's usually a more efficient way to do that. I've seen people, I'll just use like landscaper, for example. Maybe they're running a landscaping business and they're making, gross income of maybe 125 a year, and they're steady trying to itemize everything away to where they don't pay any taxes. Meanwhile, they've itemized themselves so low, they can't prove income if they need to go get a loan. They have very little income to show, at the bank if they need a loan. So, the higher, I think where we specialize is someone making a lot of money, high net worth, high income individuals. That's where we can really, really add value. And that's where I think, pointing back to the article, that whole alpha is, working with an advisor that is experienced and can, help you in other areas just outside of the investments. The other situation I want to mention, this is actually a client of mine, and he lost a family member. He lost his dad. And I am usually not one to call right away when a client loses someone, unless I know they're by themselves, right? So if they're, like a widow or something like that, it's a lot quicker phone call. But in this situation, there's friends and families. So usually I like to let some of that emotional dust settle. Then I'll reach out a few days later. Well, this client he's a mover and a shaker, and he went to where one of his dad's accounts were, and they basically gave him a check for his dad's IRA. So they cut the check in his name, basically gave him a check. And I got a phone call, and they said, hey, I need some help rolling this over. And I said, well, where did it come from? Well, it came out of my dad's IRA. So we can't roll it over. And so the thing that's valuable to know here is that with an IRA, you have something known as like the 60-day rollover rule. So you can do one of those every 365 days, and you have 60 days. If you take an IRA distribution, you have 60 days to roll it over. It doesn't work that way with an inherited IRA. And so when I asked my client to go back and speak to the bank about why they did that, the individual, the advisor at the bank, another banking institution, different location than the other story I was referencing, the individual said, I was assuming that you had 60 days to roll it over. And that's where assuming can get you in a lot of trouble. And I won't even say what assuming stands for. So we all know mom used to say that, or dad used to say that, or we've heard our neighbor say it or whatever. This is where another, situation, it could have been a lot worse. Richard, when we were discussing it, it's like, okay, it was a low amount of money. So the tax on it's not going to be catastrophic. But if it had been several hundreds of thousands of dollars, it could have been, kind of a big deal. Because this person just assumed. And the assuming is the scary part. Like, we're of the mindset when we're making decisions at the office, we're not assuming with other people's money. We are knowing what you should do. And I think that's what kind of separates us from, somebody that may work a 9 to 5. I mean, we're all in this stuff every single day, and we're not assuming when we're making decisions. So, all right, with that, I do want to, I want to go back. And we wanted to talk about another article, and we've only got about 4 minutes in the show. And so I do want to open this up by saying this article was sent to me and with the title, Great, Radio Material. And this individual is an avid radio listener. He actually has written me email before, just complimenting the show and everybody on the show, and says that, he's our biggest fan. He's not yet a client, but he's a huge fan of the show. So I said, you know what? We'll take the article and we'll talk about it. And the article is 12 signs you're doing well financially when you're over 60. Number one is having your house paid off. And so obviously the way we look at it is your house is, and the way you may look at it as well, your house is going to be a huge asset. And, one of the ways that to kind of show that you're doing well over 60 is to have a paid for mortgage. Now, Richard, I know that you and I do a lot of financial planning. We have seen situations where having the house not paid off, it's not the end of the day, right?
Well, no, especially if you were one of the lucky few people who refinanced back in 2020.
Yeah. Below 3%, right?
Yeah. I mean, right now you can earn more in cash, like if you put inside of a money market fund for the most part. But on the flip side of it too, it's, and this is what, you and I can help or do help walk clients through is that extra little bit of return really worth the mental side of things, knowing that, hey, I still have a house payment.
Yeah.
And so it's a balancing act that we have to help our clients with.
Yeah. And so just to kind of say this, just because you have a house payment, because I don't want to discourage anybody out there, because we have several clients that have, I say more than several, we have quite a few clients that still have a house payment in retirement. It's about the income generation, the assets that you have saved that will determine whether or not you can actually afford. Now, I will say from a stress standpoint, for most people, it's worth trying to get the house paid off before you actually get into retirement. The other topic here that says you're doing well is you've already completed any renovations. So I was having another conversation earlier this morning, on the way to do the show, with another client who is getting ready to retire. And I told him, I said, hey, listen, one of the things I want you to do is go ahead and start trying to take care of some of those big ticket items here in your last few years working. So if you got like your deck needs to be rebuilt, or you need to put a new HVAC in, let's either accrue for that somewhere, or let's go ahead and take care of that before you start working. One of the other areas is you're comfortable with your Social Security decision. And I'll kind of finish up here on this topic. So Social Security is a big deal. Like I think so many people, when looking at Social Security, look at it as a break even. Graham said it before on the show, where he said people treat it like a game. I don't think people are thoughtful enough with Social Security. And I don't think that when you're looking at Social Security, families are looking at the tax advantage of it, right? That's probably a big deal. My biggest, positive for Social Security is it's very tax advantage in a lot of ways, depending on your situation. And then also from the spousal survivorship option. So, let's say we've got a high income earner, and if they had waited till full retirement, let's say their income is going to be, in the mid 3,000s. That's a big chunk of money that when you pass away, your surviving spouse is going to keep. So I think that it's important to think of Social Security from a tax perspective, but then also from a survivorship perspective. So I think those are the two big reasons that I would look at Social Security and make sure that I was comfortable, because I have heard time and time again from individuals that I've sat down with that they wish they had made a different Social Security decision. You only got 365 days to do it over once the decision's made. Used to, they'd let you redo it, up to a certain point. Nowadays you can't. It's 365 days and it's done. So make sure that when you are selecting an advisory firm to work with, that they are looking at all elements of financial planning. They're looking at your Social Security, your Medicare, your taxation, your insurance, your estate planning, making sure that you are, good to go with all of your decisions there. So if you would like to set up a discovery session with us, you can give us a call at 256-937-2010. Again, the number is 256-937-2010. I hope everybody has an awesome and blessed week. Richard, it was a fun and different show today.
I enjoyed it.
Different vibe, but it's more podcast feeling, so I kind of liked it.
Appreciate you letting me nerd out a little bit.
Yeah, I love it. I'm sure some of the listeners loved it as well. So again, hope everybody has an awesome and blessed week, and remember to serve every person in every situation with a servant heart.
Investment advisory products and services made available through AE Wealth Management, LLC, a registered investment advisor. Insurance products are offered through the insurance business WG Insurance Services. WG Financial Group is an investment advisory practice that offers products and services through AE Wealth Management, LLC, a registered investment advisor. AEWM does not offer insurance products. Insurance products offered by WG Insurance Services are not subject to investment advisory requirements. AEWM and WG Insurance Services are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. WG Financial Group is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by WG Financial Group. This radio show is a paid placement.